In this video, I want to react to Autozone's latest earnings report. The earnings report was released yesterday as the moment of this recording, and the stock was basically flat when the S&P 500 dropped like a rock. So it will be pretty interesting. I didn't read the report yet, so we'll just skim through it, see what is important, and this will be the part one of this analysis. In a second video, we will listen to the earnings calls from the management of Autozone and listen to what they have to say. So in case you don't know what Autozone does, I don't know why you are watching this video. I mean, this is a video for shareholders or people doing the work. And this is auto part business in the US. They have roughly 6,000, 7,000 stores. You have a few key players like Autozone and O'Reilly Automotive, but I think I prefer Autozone because of the buybacks. This is the way the company has always worked. And I think we can start with the slides, right? It will get you a good glimpse of how the company is operating. If you look at the slides for Autozone, you have 12 slides. This is very short. And we are talking about the simplest charts ever, the simplest investor presentation ever. This is a ugly investor presentation, which I love. You have flashy colors. Obviously, this is orange. Okay. Normally, we don't get a lot of information based on the investor presentation because this is always the same story that is repeated. And now here we are for the results for the second quarter of 2025. What we can see is that sales were going a little bit up. Actually, seems like the sales are reaccelerating because in the latest quarters, all the growth has stopped when it comes to net sales. And for the same store sales, you have approximately 3%. Yeah, same thing. It is quite accelerating. You may think that the growth rate is quite low, and I agree with you. If you go to Stock Unlock really quick, you see about the financials, that you see about look at the revenue. Look at here, perfect. You see that let me check. The revenue growth has not been great. This is not a company that is growing 20% per year. You get a company that is stably growing a few percentages every year, and the growth rate accelerated in 2020, and now it seems like you reached a plateau. So maybe you will have a quick slowdown and then go back up, but on the trailing 12 months basis, look at the percentage. You are growing 1%, 2%, 3%, 3%. So don't expect anything bigger in terms of growth rate. Don't be disappointed because you see only 3% growth. Let me continue. So this is okay. Gross margins are extremely high. I mean, this is the way the business is. No improvement in gross margin. Operating expense ratio, that's 36%. Okay, more expenses. What then we have? Operating profit is decreasing by 5%. What is this note here? Includes a $14 million non-cash LIFO benefit pre-tax. Okay, so seems like costs accelerated in this quarter. Revenue was okay, but costs accelerated by a little bit more. So I will be curious to hear what they have to say in the earnings call. Interest has not changed. The tax rate was reduced a little bit. Maybe you can expect in the following quarters a lower tax rate because of the new US administration. Net income is fairly stable, minus 5%. Yeah, it follows everything. And diluted shares is down. Okay, so they did some buybacks. What did they say? They said diluted weighing average shares outstanding decreased 3% compared to last year. Okay. During Q2 2025, we were purchased $300 million in Autozone stock. Yeah, that's decent. Nothing excellent. And everything leads to a diluted earnings per share that was fairly stable. So only a small decrease of 2%, which is fine. Frankly, this is fine. And I missed this line. So the company same store sales, this increased 3%. The domestic part of the business increased by 2%. In the international part increased by 9%. Just so you know, the company has the majority of its operation in the US, but they have some operation in Mexico and a little bit in Brazil.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
And on this slide, they talk about the year-to-date performance. So yeah, this is a bit strange. The fiscal year of Autozone is not the same. I mean, we are in March, but this is already the second quarter. What can we check for the first 6 months in the fiscal year? Revenues improving a little bit by 2%. Margins are decreasing a little bit, so yeah, more costs. Tax rate is fairly the same and diluted EPS is flat. Yeah, maybe a reason why the costs are increasing, maybe it's because of an improved inventory. Like they are buying more inventory before the tariffs imposed by Trump. So maybe management is aware of this and they want to build up their inventory before tariffs are implemented. Okay. Now, as usual, you have the 3 growth priorities for AutoZone. US retail, US is their biggest market. US commercial and international, obviously. New stores, here we go. You have 6,000 stores in the US. So they opened a little bit more stores in the US, but nothing big. They closed a little bit. In Mexico, you have 800 stores in Mexico, and they continue to open stores a little bit, but nothing extravagant. And in Brazil, you have a tiny operation. I will not even look at what is happening in Brazil. That's very tiny. So US and Mexico. Okay, we expanded our footprint 47% compared to last year. We also continued our international expansion efforts by opening new stores in Mexico and Brazil. In Mexico, our footprint increased 8% as compared to last year, while in Brazil, our store count has increased 25% in 1 year. Okay, congrats. Domestic commercial highlights. What can we get here? Improvement along the way, 7% here, very well. And the domestic average weekly dollars per program is growing 4%. I mean, all the percentages you see here are quite small, but the power of AutoZone is to deliver these small numbers every quarter. And we have a commercial program, okay, very well. What about the balance sheet? I'm expecting more inventory. Inventory increased by 10%. So maybe in the part 2 of this video, they will discuss about inventory. Inventory store, nothing. Inventory net of payables is improving a little bit. Inventory turns has not changed. Yeah, seems like they are just building up inventory in expectations of what? My guess is tariffs, okay? But maybe it will be something else. Debt increased a little bit, so I would like to see how they refinanced their debt. Property, plant, equipment is increasing a little bit. Yeah, they build up more operations, more stores. And this is the end of the earnings presentation. So you always have this slide, building shareholder value. That's their priorities. Live the pledge, consistent, steady earnings per share growth, which I love. Powerful free cash flow generation, which I love. This business has been the same for so many years. Free cash flow, earnings per share, and capital allocation. They want to invest in new stores, performing stores, have more stores, more growth, and all the excess cash is returned to shareholders. And actually you see it because if you look at the diluted shares outstanding of this business, you see a large decrease. And this is the reason why most AutoZone investors invest in AutoZone. They use most of their free cash flow to do buybacks, to do large buybacks. So the priorities of the business are really simple. Earnings, free cash flow, buybacks. And they've been doing this for 2 decades already. So there is a high chance that they continue to do it. Let me finish the last slide. Accelerate growth in domestic and commercial and DIY, hubs and mega hubs expansion. Yeah, that's interesting. Like they are building more and more mega hubs in the US. So you have these large buildings that will facilitate distribution in the US. So yeah, I'm expecting way much more mega hubs in the next decade. Improve assortment and coverage, best merchandise, leverage technology. Yeah, I mean technology. Yeah, this is not an AI play. Don't kid yourself. International expansion, relentless focus on execution. Yeah, nothing big actually. Nothing big. Business as usual. No key change in the investor presentation. No key highlights. Now let me check what they say in their earnings report. Okay, domestic is increasing. Yeah, constant currency international currency was impacted here. Okay, so the international segment of this business improved by 9% in constant currency. So Mexico and Brazil. But because of foreign exchange rates, officially the sales declined on an international basis. So yeah, you have some fluctuations of foreign exchange rates, which is quite bad. Too bad. Maybe you will have a reversal. I'm guessing it's based on the Mexican peso, USD. And if I look at this chart, whoa, in the past year, you see that you had an impact. Well, it was quite minor. So if this is not in their Mexican operations, where is it? I mean, that's a good question. I have to investigate. Why do you have such a big impact in international sales in constant currency? For the quarter, gross profit, yeah, the margin was stable. We saw that operating expenses were a little bit higher. And they say the deleverage was primarily driven by investments to support our growth initiatives. Okay, so do you have a small decrease in this one based on investment in growth initiatives? Okay, I want to know more about this one. Gross profit decreased by this. They did some buybacks. They bought back $300 million worth of shares, and you have a remaining $1 billion buyback program, which is great. And okay, the inventory increased by 10%. Net inventory, defined as merchandise inventories less accounts payable, was negative. Okay, nothing big. In their commentary, they highlight the great growth in international revenue, but as a constant currency form. While currency rate moves pressures reported sales and earnings, our international performance remains encouraging as we continue to focus on opening more stores in these markets. Yeah, we have seen the numbers in the investor presentation. They continued to increase their number of stores. We are excited about our momentum heading into the back half of the fiscal year. So that will mean in the next 6 months. So back to fall 2025, up to fall 2025. And we are well prepared for our spring and summer selling season, which is better for Autozone. In the DIY market, you have more demand in these seasons. As we continue to invest in our business, we remain committed to our discipline of earnings, cash flow, etc., etc. Okay, you have a definition of the business. Very well. I want to see the numbers now. Net sales, we have no more information that we had in the investor presentation. No. What is that? The first 6 months of the fiscal year. Nothing big. Business as usual, actually. Cost of sales is increasing a little bit. Gross profit is increasing a little bit. And now you have this big gap, operating SG&A expense. So the EBIT, the operating profit, is flat compared to the first 6 months of last fiscal year. That's fine. Interest expense improved a little bit. Yeah, they have more debt and interest rates went up. Income before tax is fairly stable. Net income is fairly stable. And they did a bunch of buybacks. So net income for the first 6 months of the fiscal year decreased a little bit. But the buybacks were implemented along the way. So as a net the earnings per share were not impacted. Like you have a reduction of 1 or 2%, that's fine. Now about the cash, right? About the cash, what do we have? The same amount of cash compared to last year. Yeah, I would like to know, the latest data is August, right? Merchandise inventories. This is going up. Current assets, no. Property, plant, equipment, slightly going up based on new stores, I suspect. Operating lease of right assets, nothing significant. Account payables, nothing here. Current liabilities, no. Operating leases, liabilities. Yeah, sometimes on some websites, by the way, quick tip for you, this line can be seen as debt. This is not real debt. This is a lease liability, so not really associated with debt. Total debt is $9 billion. Okay. Working capital is here. Nothing big. And what did you do with the cash? I mean, you have a ROIC of 40%. You don't have a lot of businesses that can compound over 20 years with a return on invested capital at 45%. So for the moment, this is a good earnings report. Nothing excellent, but nothing bad. Operations as usual. And if you compare this to the past quarters in the past, since COVID, that's decent, completely decent. The D&A improved a little bit, increased a little bit. Cash flow from operations went up. Yeah, okay. Despite the inventory, capital spending, okay. This is the store count that we found in the other document. If you want to get more information, you will get plenty of information about this one. And what about inventory? Inventory improved a little bit. Inventory per store improved a little bit. And the inventory turns is the same. Okay, so it was just a quick video, guys, to skim through the report of Autozone. And in the part 2, we will listen to the earnings call, see what they have to say, see how they justify the higher inventory, see how they justify all the growth initiatives, so higher costs, and see what is their plan for the remaining of 2025.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.